And now, Lifestyles Unlimited presents the Real Estate Investor Radio Show. Over the next hour, we unfold your map to financial freedom. You'll learn how to retire through investing in single-family and multifamily real estate. You'll learn how to create cash flow and build wealth so you can have the time and money to live the lifestyle you want.
Welcome to the show. My name is Al Gordon, and as always, I'm working on your financial freedom. And on today's show, I'm kind of giddy. I'm in a really good mood because this is one of these shows where I'm actually going to agree with somebody who's in higher education. Now, I'm not going to completely agree with him because he provides data in a certain way that represents one of the viewpoints that we have at Lifestyles Unlimited, but it doesn't represent all of the viewpoints that we have at Lifestyles Unlimited. What am I talking about? Okay, there's a NYU professor. He teaches in the MBA school at the Stern School of Business at New York University, and I'm going to do my best not to destroy his name, but his name is Ashwath Damodaran, and I apologize, Ashwath, if I screwed up your name because I'm not intending to pick on you. I actually agree with some of the information that you put out. So those of you listening, you're wondering, what is it this guy put out? What did he put out that you actually agree with, Al? Because most of the time, Al, you're bashing higher education. Yeah, I do have a tendency to bash higher education because I believe in my heart that higher education gets it wrong when it comes to real estate investing. And here's why I believe that. The majority of people in higher education have been conditioned the same way you and I have been conditioned that the path to financial freedom is to go to school, get good grades, get into college, get more good grades, and then get into the workforce and hopefully get a good paying job. And then with that good paying job, maybe you get a pension. I know those are a dying breed, but there's a couple of entities out there that still offer those things. Or maybe you get a 401k or you get some type of stock options or some other bonus on top of your salary. And the idea is that you take that money that goes into those accounts that you're not allowed to touch. And if you do touch them, you get penalized dramatically for it. And the key is you build up this big bag of money, and somewhere in your distant future, provided you live that long, you live off of that money, and you put your hands together and you pray that you die before that money runs out. Because the last thing you want to be is in your late 70s, early 80s, and be living just off of Social Security because you consumed all the money that you saved up in your working years. And the only option that you have is to either eat Alpo. Yeah, there's a plug for Alpo, dog food, or go back to work. Yeah. But let me get back to the data set that I found on the internet. What I was looking for was looking for different rates of return based on different types of investments. And this gentleman, Ashwath from NYU, he basically created a 96-year data set. And I thought, wow, this is pretty cool because this makes my life easier. I don't have to go and crunch a bunch of numbers. And as long as I just give him the credit, and I'm giving him the credit for the data that he created, I can use his information and I can share it with you. Two of the big takeaways that I got from his data set is that there are a couple of different investments out there. And the ones that I want to key into are the S&P 500 rates of return over the last 96 years. I think he did a really good job of summarizing the data. And also rates of return for real estate. Rates of return for real estate. I didn't say investment real estate. I said rates of return for real estate. So what am I getting at? Okay, on the S&P 500 data, he said that over a 96-year period, the S&P 500 returned on average, provided you've been investing for the last 96 years, on average, the S&P 500 returned 11.66% rate of return per year. Now, some years it was a lot higher. Some years it was a loss. But the blended rate over 96 years is about 11.66%. That's actually a higher rate than I've reported on the show before because I haven't gone back and looked at a 96-year data set. I think what I've looked at mostly is possibly about 30, 40, possibly 50 years on my data sets, but this guy goes back even further. And, it takes into account some periods of time where the rates of return were actually pretty high in the S&P 500. Now, here's the problem with investing in the S&P 500. There are years where it's up, there are years where it's down, and the blended rate is 11.66%. The problem with 11.66% is that if you're investing your money and you're earning 11.66% blended rate of return year over year, it's going to take you 35 to 45 years to get retired. At Lifestyles Unlimited, we have a roadmap that will get you retired in 5 years or less. Now, how do you do that? Well, the way you do it, first of all, is you follow the roadmap, but more importantly, you invest in assets that give you higher rates of return. Later on the show, I'm going to cover an investment that came across my desk just this morning, and this particular investment indicates to me that if I bought it, invested in it, and held it for 1 year, it would return, now get this, a 104% rate of return when you calculate the 5 different ways we make money in real estate. 104%. That is a significantly higher number than 11.66%. Now, when you adjust for inflation, that S&P 500 rate drops to 8.4% because he calculates the blended rate of inflation over 96 years at 3.12%. So when you take the 11.66%, you subtract the 3.12%, you get an 8.4% return on investment, which is a little bit worse than the original number I gave you. So what is it that I have a concern with regards to how he is presenting data on rates of return for real estate investment? Well, what he's doing, and I'll use his own words to quote him because I don't want to put words in his mouth. He says in the real estate realm, he used home price data that Robert Shiller reports on his webpage to compute real estate return on residential real estate. That series has now morphed into the Case-Shiller Index. So what's the Case-Shiller Index? Well, it is a kind of a complicated thing. Let me just break it down for you. The Case-Shiller National Home Price Index is a composite index of the single-family residential real estate values in 9 U.S. Census divisions. The index itself, its method of calculating the home price index adjusts the weighting for the quality of sold homes. And the indices are seen as one of the most reliable measures of housing price trends in the United States. Now, after peaking in 2006, home prices sharply declined in 2008 as a result of the housing bubble bursting. But keep in mind, everything that I've just told you about is related to residential real estate that you would buy and live in. The Case-Shiller Index doesn't necessarily look at real estate based on an investment standpoint. And later on in the show, like I mentioned in the beginning of the show, I'm going to cover a deal that came across my desk this morning that in a 1-year period of time is poised to return about 104% return on investment when you look at the 5 different ways we invest in real estate. Now, I should say the 5 different ways we make money when we invest in real estate. That would be the proper way to identify that. So let me get back to this indices that the NYU professor put together because I don't want to butcher his name. That's why I said it that way. My point is he takes a look at rates of return for real estate, and he's using that Case-Shiller Index. And when you look at the blended rate over a 96-year period, the blended rate of real estate, when you look at that 96-year trajectory, is 4.22%. 4.22%. That's actually a little bit better than the amount that I tend to quote on the show. And the amount that I quote on the show is about 3.5%. Where do I get my data from? Well, I get it from looking at trend data that tells me that residential real estate tends to increase in value by doubling every 20 years. So when you take a look at what does real estate have to go up in value each year to get to a doubling effect in a 20-year standpoint, it works out to be about 3.5%. The professor says it's really 4.42% using the Case-Shiller index. So I kind of like his number a little bit better. I do. But when you take into account the blended rate of inflation at 3.12%, you're only getting a 1.28% increase in value. So how in the world would you retire on a 1.28% rate of return? Well, you don't invest in those types of assets. Effectively, those types of assets that they're describing are retail valued assets. When you become a member of Lifestyles Unlimited, we're going to teach you how to buy properties at wholesale prices, not retail prices, but wholesale prices. Because when you buy at wholesale prices, it gives you the opportunity to do something called equity capture. What that means is you buy the asset at wholesale pricing, you fix it up, it's going to cost you money to fix it up, but your all-in cost, once you calculate everything that you've actually spent on that property, is still less than the retail value of that asset in the marketplace. The difference between that wholesale pricing and the retail pricing is something called equity capture. It is a way for you to double, triple, even quadruple your wealth just by buying a single real estate asset. It's pretty cool stuff. Now, what I want to do is I want to talk about how you can effectively increase your net worth. Well, you do it by buying a real estate asset. You do it by buying that real estate asset at wholesale pricing. The key word is wholesale pricing. So how do you find these types of assets? Well, the easiest way to do it, and I'll just be upfront and frank with you, is to become a member of Lifestyles Unlimited. We teach you the methodology to get that done. As a matter of fact, as a part of our 16-hour financial freedom seminar, that's the educational program that every brand new Lifestyles Unlimited member goes through. Every one of us who's a Lifestyles Unlimited member has gone through that educational program. It takes 16 hours, not 16 years, not 16 months, 16 hours to get the education. A portion of that education discusses property location. We actually show you, and we go live on the internet, and we as a collective class, we find a particular asset that's available in the marketplace that anybody could buy right there on the spot. And people do buy it right there on the spot in the class. But more importantly, by teaching you how to locate property, you learn how to find wholesale properties. You learn what to look for. You understand what the parameters are. And then you can coordinate with professional real estate agents that you put onto your team. And in doing so, you can give them very particular information that you want them to follow. And in doing so, they'll be able to help you by using the multiple listing service find properties that are available for purchase at wholesale pricing. We'll also discuss the concept of using wholesalers. Now, you have to be careful when you're using a wholesaler because a wholesaler does not have a fiduciary obligation to anybody. The wholesaler's in it to basically flip a contract to a real estate investor so that they can get paid a fee for doing so. So why would you have a real estate agent on your team working on your behalf to work with wholesalers? The key point is because that real estate agent has a fiduciary obligation to you, and they will be an extra set of eyes and ears to help you make sure you're not making a bad decision. We come back from the break, more on NYU and you. Stick around.
Got questions? Call Lifestyles Unlimited at 855-497-4335. The Real Estate Investor Radio Show continues next.
Lifestyles Unlimited Success Stories.
If you got laid off tomorrow, what would you do? Would you have to be working at McDonald's or wait to try and find another job with the downsizing the economy? Kept on coming to meetings, even with David Fisher online and stuff like that, but still we just we need to make the jump.
So we kept praying for time to get this job done to be able to find the properties. How do we find the properties? How do you find the time? And God answered our prayers, and he got downsized from his corporate job. This house was a dog, and through the rehab, I think we turned it into a little pony.
You bought the house for $73,000.
Correct.
And your appraised value actually is $144,000. You put in $45,000 worth of work, so that leaves you a net equity of $11,000 with a return on capital gain of 70%. The cash flow is $458 a month for a cash-on-cash return rate of 35%.
In-person and online learning dates at lukstudy.com.
Creating the lifestyle you've always wanted. You're hearing Lifestyles Unlimited's Real Estate Investor Radio Show.
Welcome back to the second half of the Lifestyles Unlimited Real Estate Investor Radio Show. My name is Al Gordon, and as always, I'm working on your financial freedom. And I'm doing so today with the help of an NYU professor that provided me a data set that I found to be very interesting. Now, ironically, the professor is a professor of corporate finance and valuation. And what he's articulating in the data set that he posted on the internet is a rate of return if somebody were to invest in the stock market. And he compared that to some other forms of investing. But one of them that I found very intriguing was the real estate aspect. He included real estate in his analysis. Now, he included some other things, but I'm not going to get into those other things because when you look at his data set, the one area that he says gives you the best bang for the buck, if you will, is investing in the stock market, specifically in the S&P 500. He goes on to say that if you invested in the S&P 500, you would actually get a blended rate of return after inflation of about 8.4%, as compared to real estate that if you added in the rate of inflation, the blended rate of inflation, you would only get 1.28%. The problem that I have with this data set is that he is focusing on houses that you would buy to live in and hope that they go up in value. That's what most Americans do. You go out and you buy your dream home, so to speak, or at least your wannabe dream home, hoping that you eventually upgrade to your dream home. People with the mindset that the professor has, and I'm actually putting words into his mind, and I don't think that's very sanitary, according to Del Walmsley. That's not sanitary at all. So I'm not going to say that. What I'm really going to say is that he's looking at it through the lens that most people look at real estate from. You buy a house to live in and hope it goes up in value, and then somewhere down the line, you sell the house, you take whatever equity gains that you get. He's saying you get a blended rate of 1.28% per year, and you buy an upgrade to your next house. That's the mindset that most people have in America, and that mindset was injected into your brain at an early age. I should say at an early age, because most of us were taught that the path to financial freedom is to go to school, get good grades, get into college, get more good grades, get into the workforce, hopefully get a really good paying job. And with that good paying job, possibly you get a pension or you get stock options or maybe a 401k or something else to sweeten the deal, right? And then you trade 35 to 45 years of your life trading time for money, building up what is hopefully a nest egg that you live off in the future you, provided you live long enough to tap into that future account. Does that make sense? I know that makes sense to you. Okay, so I really can't pick on the professor because, I think he has that mindset. He's not looking at real estate from its investing potential. See, when you become a member of Lifestyles Unlimited, you're going to look at real estate for its investing potential. You're going to look at it and you're going to realize that when you look at real estate in a completely different way, there's a lot of money that you could make in real estate. And a little later on in the show, I'm going to talk to you about a deal that came across my desk literally this morning where you can make 104% return on investment based on the 5 different ways we make money in real estate in just 1 year. It actually does better if you hold it for a 5-year period of time. But since I'm looking at annual rates or blended rates, I think it's only fair to talk about a 1-year rate of return when I analyze a property. Does that make sense? Okay, so what I'm getting at is that real estate is a great vehicle for you to harness so that you can get yourself retired in 5 years or less. You heard me correctly. Not 35, not 40, not 45 years. 35 years is too long. 40 years is too long. 45 years is too long. And some of you are going, wait a minute, Al, I already got like 20 years into the game. That's fine. That's totally fine. That means you've probably saved up a big bag of money. And you could actually repurpose that money into real estate and get yourself retired in 5 years or less. And you're screaming at the radio right now. You're screaming, but wait a minute, I'd have to pay the taxes on that money. So you have to pay the taxes on it. You know, you're going to have to pay the taxes on it whether you take it out today or you take it out 15, 20, 30, 40 years from now. You're still going to owe the taxes. So what's your point? Well, my point is there's a penalty. I'm not 59 and a half years of age or older. I'd have to pay an additional 10% penalty. Okay, I hear you. That's what we call an ignorance tax at Lifestyles Unlimited. And I'm not picking on you. I'm just saying you just didn't know what you didn't know when you decided to go that route and put your money into those investment vehicles. You didn't know what you didn't know. But there is a saving grace. There is a way to avoid the 10% penalty. Are you interested now? Okay. When you become a member of Lifestyles Unlimited, we have something called a vendor program. Now, the vendor program is designed specifically to give you access to all types of different entities that are out there that you would put onto your personalized real estate investing team. And you'll understand why the importance of the team is so important when you become a member of Lifestyles Unlimited. And I'll just give you the insider's edge. It's because you take advantage of the expertise that other people have because you don't have it yourself. And one of those areas of expertise is a group of lawyers that know how to use the tax code and know how to use divorce law to get you your money without paying the 10% penalty. Now, some of you are saying, whoa, you said divorce code. I'm happily married. I have no desire to divorce my wife. Well, you don't have to. That's the neat thing about this. You don't have to divorce the person that you love. Whether you're the man, you're the woman, or whatever, you don't have to divorce the person that you love. These attorneys know how to take advantage of what the law affords you so that you can migrate away from paying the 10% penalty. Now, I'll forewarn you, you need to be happily married. Yeah, it doesn't work if you're single. It doesn't work if you're divorced. It doesn't work very well if you're in a very difficult marriage that's heading towards divorce. Where it works best is when you and your spouse are on the same sheet of music about everything in your marriage and you are happily married. Because what they do, let's call it money magic, because that's exactly what it is. They take advantage of what's out there in current law, and they're able to migrate the money from your retirement account to your spouse using divorce law without having to get divorced. It's not fraud. Come on, attorneys do what attorneys do. And I know there's a ton of attorney jokes out there that we could talk about. Now, as promised, I'm going to get into this property that was sent to me earlier today, this property that can return 104% return on investment to you in just 1 year worth of ownership. Now, I'm looking at a picture of this property, and I don't even know if ugly is a proper term for it, because I think ugly might be an upgrade. It's a 3-bedroom, 2-bath, 2-car garage house. And I'll tell you, it's ugly. It's ugly. The floors, they look like they're the original floors from the 1980s, because they are the original floors from the 1980s. The countertops, they're in bad shape. Now, what excites me about this property is the fact that you can make 104% return on investment when you take into account the 5 different ways we make money in real estate. There's the cash flow. There's the equity capture. There's the natural appreciation. There's principal pay down. And then there are the tax advantages, which protect you from paying taxes on the income or the cash flow that you make on the asset. That allows you to get a blended rate of return of 104% over a 1-year period of time. Now, if you held this asset for a total of 5 years, I'm estimating that your blended rate of return would be 335%. How do you make 104% in year 1 or 335% in year 5? You buy it correctly. You buy the asset for what it's really worth in today's market. Now, when I went on to Zillow thought that the property was worth $185,000, except this property is not worth $185,000 because it's beat up. It's going to take almost $80,000 in repair costs, based on my estimates here, to bring this property back to its glory days when it was built in 1981. So what's the property really worth? Well, Greg, the realtor that sent this property to me, said that I can buy it for $88,000. That's a far cry from that $185,000 that Zillow thought it was worth, right? Because this property is made available to me from a wholesaler. A wholesaler is somebody that goes out and finds a property that's kind of beat up, that isn't worth much, and they get a contract for sale on the property. But the wholesaler has no intention of buying the property. So what do? They flip the contract to somebody like me, who's a real estate investor, who does have the ability to buy the asset. And in doing so, they earn a fee. In this particular case, they're asking for $3,500. Now, that may sound like a lot of money to you, but to me, $3,500 is chump change when I can buy an asset for, get this, 41 cents on the dollar. The property, all fixed up to 2024 standards, is worth $213,000 in the marketplace that it currently exists in. Now, because just about everything is wrong with this property, it's going to cost almost $80,000 to repair the property. So a lot of you are thinking, wow, you're spending $88,000 to buy it. You're spending another $3,500 for a wholesaler fee. You're spending $80,000 for rehab costs. Where are you getting all that money from, Al? From a hard money lender. A hard money lender is somebody that will loan me up to 70% of the after repair value. Based on an appraisal on that asset, they'll loan me up to 70% to not only buy the property, but to cover some, if not all, of the rehab costs. So what's it really going to take for me to invest my physical money to get this property? $24,000. I'm only putting a little over 11%. See, when you become a member of Lifestyles Unlimited, you'll understand how to do this stuff. Now, I'm also going to capture $35,500 in equity in this asset. That means that I'm not even going to spend a total of $180,000 on this property. I'm going to spend less than that. And the difference between what I actually spend to include the $24,000 of my own money that I put into the asset, I'm going to get a great deal on this property because I'm going to capture an additional $35,500 over and above the $24,000 that I put into the asset. That gives me a 148% return on the capital gain. Now, cash flow wise, it is poised to return $363 per month. When you annualize that, that's like giving yourself a $4,356 raise per year. That's an 18.15% return on investment when you base the fact that I'm receiving $4,356 per year in cash flow, and it only cost me $24,000 to buy that stream of income. Are you starting to see why I disagree a little bit with the NYU professor's projection of what real estate is actually returning? Because he's only looking at one segment of the market. I'm looking at a completely different segment of the market. So when you annualize the investment over a 1-year period of time, and you take into account those 5 different ways we make money into real estate, it's pretty darn cool. This gets you to that 104% return on investment at the end of year 1. If you go to the end of year 2, it jumps up to 160%. At the end of year 3, 216%. The end of year 4, 274%. And then if you hold the property for a total of 5 years, you could expect to make a 335% return on investment on just this one asset. And if you got a lot of money to spend, you got a lot of assets you can buy. If you want to do what I'm doing, you want to do what the 50,000 members of Lifestyles Unlimited are doing, go to lifestylesunlimited.com. Sign up for that free workshop, and let's get you going.
The information and opinions you hear on the Lifestyles Unlimited Real Estate Investor Radio Show are those of the hosts, guests, and callers. The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.